Good afternoon, and welcome back to this edition of TBD Micro, your Colorado Springs podcast. I'm Rob Thompson, Associate Broker, and joined again by Troy Reichert.
Hey, it's good to be here again, absolutely. So,
thanks. We actually have a full house today. I'm going to give a couple other shout-outs. We got Mocha Miller, who's an agent here with the brokerage as well, listening in on the podcast. Hello. Hey. We also have Lauren Ness, who's shadowing, considering a career in real estate. Hello. Hey. You can't see, but we also have Maximus, the real estate dog. You might hear him clicking around with his nails. And my daughters are actually watching Johnny Turbo, something in the background on Netflix. So
it's a complete family affair here. I love it.
Yeah, it's a community event today. But I'm here with Troy, and we're going to talk today about bankruptcies and their impact in the mortgage process. Is that a fair summation of what we got?
Absolutely. Different types, how they affect when and how you can purchase homes.
Okay. Well, before we get there, just a couple interesting stats, I think. As we sit here right now, according to the Pikes Peak Association Realtors MLS, dated, what's today's date? Today is the 12th of June at approximately 2:22 p.m. There are 2,075 active listings in the MLS. That's not under contract, just active listings, which is near historical lows. We've been hovering around this 2K range, 1,800 and 2K properties for several months, if not a year. There are 1,868 single-family homes in the market. So of those 2,075, 207 are townhomes, condos, etc. So very low inventory. 1,800 single-family homes, as I said. 399 of those are 300K or less. 1,483 of those single-family homes are 300,000 or more. So historical high pricing. There have been 907 single-family homes sold above 300K in the last 30 days. And there are the 664 homes sold for 300K or less in the last 30 days. At that 300K less price point, that means that there's 2 weeks of inventory at this rate of sale. In a healthy, quote, balanced market, it's 5 to 6 months worth of inventory. So it's still, particularly 300K and below, it's a seller's market. Above that, we have actually also 2 weeks worth of inventory. So still a seller's market. Just two more data points. The average closed price of a house sold in the last 30 days is $355,000, which is a leap from even just last week.
That's right.
And then the median home, which is a massive leap, is $320K from the median home values. Collective days on market are 20 overall, and regardless of price range, it's 20 days on market, and 5 is the median. Which means it's a moving market still.
Completely nuclear at this point.
Nuclear hot. Like the surface of the sun hot.
It's crazy.
So if you're looking to sell, now is a great time. If you're looking to buy, I think we've had this conversation before. Buy for the long haul because there's no guarantee that these prices are going to continue to appreciate at this rate.
Yeah, and we'll have to do a podcast some other time about people getting squeezed out of the market a little bit, maybe, but. It corrects itself. It's a cyclical thing, so we'll see how long it lasts. But definitely want to be informed of how that market is going for sure. So I appreciate you providing those data points.
Oh, thanks, man. Yeah, on the micro, something I've been saying, beating the drum for a while now is make sure to plan at your micro level. Don't bank on continued appreciation. Make sure it's a sound investment for you on the long haul. But and this is a good segue into the topic, because otherwise you might put yourself in a position of bankruptcy or short sale or what have you, and then you'll need this information that Troy's about to share. So let's talk about that, man. How does bankruptcies impact a mortgage?
Yeah, absolutely. And it's not necessarily a fun topic to talk about for sure, but I think information is power. You know that. So if you are in that situation or potentially leaning towards doing that, I will never recommend one way or the other. That's not my place. I just look at information and help you try to make an informed decision. So what we're talking about here today is the different types of bankruptcies, how they're presented on credit reports, and what kind of impact, positively or negatively, believe it or not, those bankruptcies can have in purchasing a home. So I'll just go ahead and get started right away. We're going to be talking about really two different types of bankruptcies, the Chapter 7 and the Chapter 13, and I'll tell you about the differences in each. There is a Chapter 11 bankruptcy that's similar to Chapter 7. That's more for businesses, and sometimes that can affect purchase power depending upon if you are self-employed. But we're going to focus primarily on Chapter 7 and Chapter 13 bankruptcies today. So the Chapter 7 bankruptcy, for lack of a better term, is kind of a wipeout bankruptcy. You can pick and choose or just wipe out your entire debt profile using a Chapter 7 bankruptcy. And it allows them to discharge most, if not all, of their debt obligations, to include mortgages. So the Chapter 13 bankruptcy is more of a reorganization type bankruptcy. It allows individuals to repay debts while they're in the bankruptcy based upon a payment plan that has been signed on and also approved by the bankruptcy courts. Sometimes those payment plans can have lower rates, lower payments to allow you to weather the storm and the reason why you had to declare bankruptcy in the first place. And neither one is better than the other. It just fits the individual's particular situation at the time. And we got to work through those things for sure. So those are the different types of bankruptcies by and large. And those bankruptcies, even though there's restrictions potentially, can and will still show up on your credit report. So sometimes they don't. I'm seeing where they don't necessarily show up, believe it or not. But those rules are changing a little bit. But by and large, they do show up. I actually prefer it because, again, information really helps us work through what we need to do. So let's talk about Chapter 7 bankruptcies and how they affect certain things. And we're going to basically talk about the different types of loans you might be trying to qualify for: conventional loan, FHA loan, VA loan, and USDA loan. So we'll focus on the Chapter 7 bankruptcy first. The Chapter 7 bankruptcy requires at least 4 years seasoning. What does seasoning mean? Seasoning means that from the discharge date to 4-year anniversary, you are in effect locked out from purchasing a home. They want you to have that time and get a credit established during that time to be able to feel comfortable enough to lend on a mortgage again. Again, everything's about risk, right? So just think about the word risk when you're thinking about why they have these things in place. So you have to have, now sometimes a 24-month seasoning period may be allowed on a conventional loan. Those are very few and far between, and you have to have extenuating circumstances to be able to qualify for that. Again, talk to someone like myself, a mortgage expert, to see if those extenuating circumstances might actually apply. So that's the conventional loan. Just think, if I have a Chapter 7 bankruptcy, 4 years, maybe 2, okay? On an FHA loan, they're a little bit less restrictive. They allow 24 months seasoning requirements on a Chapter 7 bankruptcy. However, extenuating circumstances, you might be able to do as little as 1 year. So they basically cut both times in half. Now the other time is a VA loan, and they basically mirror the FHA. So 24 months or 2 years seasoning is generally required. However, for extenuating circumstances, maybe a year from that discharge on a Chapter 7 bankruptcy. The USDA, you don't see as many of those types of loans, but the USDA generally prefers 36-month seasoning, but will look at 12 months. So those government programs, USDA, VA, FHA, less restrictive than those conventional loans. So think about those things. Now, what I would absolutely say is don't wait until those times to contact the lender. You want to potentially look at the reasons for those events, and do you need to get credit established? Do you need to do those kind of things? So I would say, as a good mark, about a year out from when you're looking to purchase, regardless if you have a bankruptcy or not, you should really contact the lender to see what is on your credit report, how does employment look, all of those factors to make sure you're in the best position possible for when you're looking to purchase. So,
Okay.
now we're going to be also looking at the Chapter 13 bankruptcy. Remember, that's that reorganization bankruptcy where you're making payments. It looks like we're losing a member of our family over here, so she had to go. But thank you so much for hanging out.
Thank you so much.
All right. And so Chapter 7, we covered. Chapter 13 bankruptcies, again, that reorganization bankruptcy. is where you're making payments through the bankruptcy, through the plan. And believe it or not, Chapter 13 for conventional only requires 24-month seasoning, and it kind of makes sense. The risk factor is less because you actually decided to make a plan to pay off those debts. So mortgage companies feel more comfortable, conventional loan-wise, to be able to lend at an earlier situation. So think about that. The FHA loan on a Chapter 13, you don't even have to be discharged. So you can be in the payment plan on an FHA loan, and actually you want to be in you want to be in the payment plan to be able to do that potentially. You do need to have permission from the bankruptcy court to move forward on that. You have to have at least 12 payments on the payment plan, so basically 1 year on that payment plan to be able to move forward while you're in a Chapter 13 bankruptcy on an FHA loan. So it's actually easier, quote unquote, to be able to qualify and purchase a home on an FHA loan while you're in the bankruptcy. Once it's discharged, you have to wait those 24 months before you do that. So a little bit of a wrinkle on the FHA, which from a lending standpoint I don't necessarily understand, but they do put that in there too. You have to wait 24 months after the discharge on a Chapter 13 to be able to move forward. On a VA, what it states is that it's satisfactory on a Chapter 13. There is no seasoning period after the discharge. You can go ahead and do that. If the borrower is in an active Chapter 13 bankruptcy, once they've made those 12 payments on the repayment plan, then they can take a look at that and be able to do the VA loan. The one thing that they would also like is to have satisfactory credit established, so on those FHA and VA loans. For the Chapter 13 on a USDA, a 12-month payment period history is fine, and has to be discharged for at least 12 months, so a little bit different on the USDA. I did get a question here about what would be considered extenuating circumstances. It's a little squishy. So, so what you have to do is you have to present it to the underwriter. It's a little bit of a gray area. I can tell you what is not considered is like loss of a job. That is not considered normally. Now, if there was a circumstances that created the loss of a job, such as a debilitating injury, they look at those. If there's a significant loss, of income for one reason or another, we could take a look at it potentially. But the answer is you don't know until you see it. It's not spelled out. They put a gray area in there on purpose so you can have them evaluate it to see if it makes sense. So I would say a lot of times the ones that I see that are approved, if there was some type of significant medical thing that allowed or disallowed somebody from working, and they will no longer be able to do that, but they qualify otherwise, then that caused the bankruptcy, right? That medical issue. So that's one reason. Unfortunately, you can't give a list of things. I would just say, if you want to look at that, let's get it sent in and get it approved or disapproved. So
seems like the guideline says, correct me if I'm wrong, the guideline says extenuating circumstances, then what that means is kind of up to the underwriter and the lender.
That's correct. The underwriter and the lender and a lot of times what the underwriter will do is they have direct access to the FHA. So they can actually say, hey, this is what we're planning to deliver to you. Is this something that would work?
Does it conform? Gotcha.
That's correct. So,
gotcha.
And me as a loan officer, I don't have that access. I mean, I know enough again to be able to say, hey, let's take a chance on this one and send it in and see what they say. So another one is divorce a potential extenuating circumstance? The answer normally is no.
Wow.
So now again, there might be the reason for the divorce might be the extenuating circumstance, but I would say let's take a look at it. Let's see if it makes sense from a case-by-case basis. You can't say hard yes or hard no on any particular reason that comes up.
All right. Boca, did you have another question?
I'm the one that's been feeding Troy the questions.
Yep, that's awesome.
No, so those are great questions, and I would just say that's why having an experienced lender that can help you walk you through the process and be super informed is really, really important. Just make sure that you understand if you're in a bankruptcy, it does not necessarily lock you out of purchasing a home. But if the answer is you need to wait a little bit, let's use that time wisely to give you the most bang for your buck and get you super prepared down payment-wise, credit-wise, employment-wise to be able to step off in confidence when you're ready to go.
So takeaway for me is bankruptcy isn't necessarily a disqualifier given the seasoning time frames and such. It's certainly not a 7-year disqualifier that a lot of people perceive it as.
That's correct, absolutely. Now, while it shows up on your credit report for quite a long time, it doesn't mean that you should not take a look at purchasing a home.
Well, I can tell you, I was able to qualify for a home 23 months after a short sale, which it largely centered on the characterization of how they reported the loss from the short sale on my credit. Bottom line, always talk to a knowledgeable lender like Troy, because there are exceptions and there are ways of characterization and such that can affect this stuff too.
That's correct, and I didn't want to make an hour podcast. There are short sales and what's called deed in lieu, those kind of things. So we can definitely talk about those types of characterizations. That's more mortgage type stuff than bankruptcy, but there's a lot of things to look into, and that's good information to have too. We'll probably have to put that on our calendar.
Yep, we'll do that. Okay, any thoughts? Anything?
I think, yeah.
No? Okay, no. Oh, thanks, Troy. How do they get a hold of you if they're interested in further information or attempting to qualify?
Well, there's a few different ways. I always give out my cell phone number. That's the best way to get a hold of me. 719-205-0413. Again, 719-205-0413. They can always check out www.reichertmortgage.com. There is an Apply Now button. Feel free to do that if you prefer to do that route. I'm always a guy who likes to meet people and shake hands and make sure that everything is good to go there. But phone call is always best. My email is Troy at Integ. That's short for integrity, INTEG, and then the word first.com. So Troy at integfirst.com.
Right on. And okay. Well, thanks for your time, Troy. Any last words?
No, I was a complete failure in providing a book recommendation this week. I will double down next week.
Fair enough. I'm listening podcast-wise. I have a recommendation this week. Gary Vee. If you're an entrepreneur and you are looking for motivation, Gary Vee is highly motivating. I don't always agree 100% with him philosophically, but every podcast is energetic. So, let me ask you one more quick question. We usually round this out. Mortgage rates. What are mortgage rates doing?
Yeah, that's a great question. They're generally kind of inching upwards. They're not screaming, they're inching. So conventional loans, you're probably looking at mid to high 4s with good credit, slightly lower for your FHA and VA loans. So, but you definitely don't want to think that interest rates are going to come down and that you're going to be able to have a lower monthly mortgage payment by anticipating a lower interest rate.
Yeah, not to get political, but there's a lot of variables going on and talks of trade wars and things like that. The interest rates aren't going to fall while those talks are going on.
Yeah, it's always fun. There's a million different factors out there. Some we know are coming, some we don't. So I would just say if you feel comfortable with a monthly payment and an interest rate and what people are doing for you, now's the time.
To lock in. One thing I was reminded of recently is one of the mantras of why a mortgage can be better than renting. Not always, but can be. It locks in the price of housing. So if you look, 30-year fixed payment. So anyway.
That's right, because renters can always change the rent once the agreement is up. So just something to think about.
Yep. Well, thanks for your time, Troy, and I'll be back. Well, look forward to chatting next week.
Let's do it.
Thanks, man.